Call it. Alphabet CEO Sundar Pichai talking about efforts underway for multi-year savings. He made those comments on Alphabet's first quarter call, and that maybe was part of the picture that helped ease worries among investors who were expecting the worst due to macro headwinds and the resulting drop in advertising spend. Joining now to discuss the resiliency of tech as companies continue to focus on efficiency is Brad Erickson, RBC Capital Internet Equity Analyst. Brad, it's good to see you. Of course, part of the question for Alphabet was demand, but of course the other half of it is what's been going on more broadly in tech on the expense line. How do you think Alphabet is doing on that front?
Yeah, I think fortunately for them, the top line was relatively good, probably a little better than feared even last night. They didn't give us a lot on the expense line. If anything, it was kind of a marginal negative. What they said was they're actually going to see a little bit of an increase in their CapEx year over year this year, that compared to what they had said last quarter, where they had said it would be flat. And then on the operating expense lines, they kind of gave very vague commentary. They expect revenue to grow faster than expenses, but didn't give a lot of detail there, and certainly didn't do anything on the nature of cutting incremental heads, for example, of employees or anything of that nature. So, Google's kind of been a laggard in terms of showing more pronounced expense reductions here lately, but they are doing what they can, and their business is actually running fairly well, so they haven't had to in some ways.
It seemed like a great deal of both calls really focused in on investments in generative AI and what that could do in Alphabet's case for what still makes up the lion's share of its business and advertising revenue driven by search and other subsidiaries, and then for Microsoft, kind of a early victory lap, if you will, but saying that they're going to continue to build off of it. And so all of that considered, did the conversation kind of net out who would be a clear winner, or if there would be a generational shift that also meant a shift in the revenue that these companies see as a matter of search?
One thing I would note, I don't cover Microsoft, so can't really speak for that stock in particular. What I can say for Google is that they continue to be relatively unpromotional, I would say, about their AI efforts, and particularly their generative AI efforts, which obviously competes with ChatGPT. We fully expect them to continue to roll out products and continue to demonstrate more and more value that these products can bring, and ultimately revenue they can drive longer term. But yeah, I would say at this point they are losing the narrative in the court of public opinion at this point. And I don't see that necessarily changing here in the near term.
To put it another way, does Google need to be worried about its search dominance?
I think clearly that's a question that everyone's asking. And when ChatGPT initially came out, there was this sort of unprecedented, almost existential crisis that got built into the stock very quickly. We don't think so. We do a lot of channel work. We talk to advertisers around this front. Nothing has changed here in terms of the demand for Google search as a channel for advertisers. And I think, as evidenced last night, the company beat search revenue by $1 billion, which is only 2% in fairness. But still, the fact that they're still beating consensus expectations there, are we talking about nothing when we're talking about this apparent existential risk to search? We think so.
Just lastly here on Alphabet, YouTube, that was an area that actually saw year-over-year decline, so some weakness in the revenue side. They did talk about the growth in shorts, saying that they're seeing some strong creator momentum, daily uploads. By all that considered, is there a sign that YouTube Shorts and YouTube holistically is not only going to be a perhaps beneficiary of AI-generated content, whatever that may look like in the future, but then also that they're staving off where TikTok or where Instagram Reels is trying to take some of that advertiser dollars and revenue away by creating a more monetizable or return on investment ad campaign through those other platforms?
Yeah, is the short answer to your question. Broadly, I would say YouTube showed some good stabilization. You're right. They are continuing to show year-over-year declines, but they've also missed, I think, 4 or 5 quarters in a row, and they finally did not miss this quarter, which was a marginal positive. I think more particularly to your point on YouTube Shorts, yeah, I wouldn't surprise us to wake up say 3 years and find that YouTube Shorts is actually one of the strongest competitors in short form video. They're paying creators more than TikTok or Instagram can on Reels at this point with their revenue share program. And I think, when you think about TikTok lately, our checks have suggested that their return on ad spend has been deteriorating somewhat, and advertisers are moving some dollars over to other platforms. YouTube Shorts is absolutely going to be a candidate to grab